Hey everybody, welcome to tonight's webinar with the Angel Network Company and coaches. Tonight is Valuation Secrets that Save You from the Sharks. We have Greg Ryder on the line and other Angel Network coaches, David Spoon and Ed Bracken. Take it away, gentlemen.
Thank you, Emily. Oh, it's a great day. It's a Friday. I'm overlooking Grand Avenue, and we have Cruisin' Grand coming up, and all the cars from the 50s and the 40s and the 60s, so we're going to have fun tonight. And I want to say thank you for everyone who is here listening. I know your time is valuable, and we want to make this some of the most valuable time you've ever spent. Before I get into that, I want to share with you just a little bit Angel Network, and we've been around since 1997. I'm a former investment banker, and on my previous webinar I shared my history, so I'm not going to do that again today. But we are an educational-based company, and our goal is to educate and motivate and help entrepreneurs get the capital they need to create the jobs, to create the dreams, to get their inventions to the marketplace, and to really live the American dream of free enterprise and capitalism. And on the flip side of that, we do have an educational system where we help investors learn how to invest in early-stage startup companies without losing their shirts. We teach them to look for the red flags, what to look for, cap tables, cap structures, valuations, term sheets, all those kind of things. So, and at the end of the day, our goal is to match make entrepreneurs with investors. We are not lawyers, we are not accountants, we're not tax advisors, and we are not broker-dealers or investment advisors. So we do not take commissions for anything that we do. We only charge fees for our educational-based products and services and our coaching program. So there's the little disclaimer. With that said, let's get going. So my goal again for today is that this will be the most valuable and impactful 60-plus minutes you've ever spent. And the reason I say that is because we are going to reveal to you strategies and a complete understation, there's a great word, understation. Please add that to the dictionary, somebody. A complete understanding of valuation, in quotation marks, valuation, that would eventually be worth hundreds of thousands or maybe even millions of dollars to you. And I can't stress this enough that literally this training, this information, I don't know anybody that teaches it to the average entrepreneur. I learned it because of my 17 years as an investment banker and owning my own broker-dealer, and I'm sitting here telling you that when you understand valuation, it literally could save you hundreds of thousands of dollars and possibly millions of dollars, and maybe tens of millions of dollars, because when you understand this, and as we get through tonight, I think you're going to understand that and you'll see exactly what I'm talking about. So, as I mentioned on last week's webinar, I'm just going to kind of recap. We talked about the marketplace and how things have changed. In 2007, there was $26 billion invested by angel investors in 250,000 or 258,000 different investors and 57,000 deals. 8.9 billion in 2001. So you can see the numbers have dropped drastically. So we say that to say this. You're in the right place right now learning and getting educated, because if you're out there and you're serious about capitalizing your company and getting the money you need the knowledge, you need the language of capital, you need to understand these principles, these strategies, these tactics, or you, bottom line is, you don't stand a chance to get funded. You literally are doing what you need to do to get funded, and we're going to help you do that, because it's all about knowledge, and the only reason you're not getting what you need is because you don't know how to do it. And once you know how to do it, you can do it, and again, you're at the right place. So if you need money and you want to raise capital, you're at the right place. It doesn't matter if it's $250,000 or $1 million or $5 million. You need to understand the things that we're teaching and what's going over. I am very excited to say that yesterday a new law was signed by President Obama. It was called the Jobs Act. And I put together a video and I put together a press release. And again, this is a little marketing strategy, because we're also marketing gurus as well, which is kind of unique. We're one of the few people that not only can coach people and mentor people and help you with your funding and your cap tables, your capital structure, where to find investors, introduce you to investors, but on the other side, help you with your marketing, your internet marketing, your offline marketing. And one of our marketing strategies we do is press release distribution and press release marketing. And whenever possible, I like to piggyback off national news. So I made a video, me talking about the Jobs Act and what it means to entrepreneurs. We wrote a press release. We released it over the National Wire Service, and we have links back to our website. So now we're getting thousands and thousands of visitors to our website because every news organization in the world is promoting this whole Jobs Act, which basically says the average entrepreneur is going to be able to market his investment, his equity investment, online to the masses. Never been done before, never been legal before. It's coming. It's here. The law is signed. And next week, our next week's seminar is Crowdfunding Explained. We're going to go into detail what this law is, what crowdfunding is, how you can use it immediately, and how you'll be able to use it in the future for selling your stock and your equity. So that is going to be a huge class. You got to make sure you get on early for that one, because that one will fill up with. I wouldn't be surprised if we don't have 1,000 people for next week, because this is a big, big, big hot issue. And I have taken the time, and I told me earlier, I'm already an expert in this. I know what's going on. I've been following. I've been reading it. I actually read the whole entire law last night twice. So I'm ready to share that with you next week. So when it comes to investors, everything starts with blank. Now the hint is, okay, so if you're on there, here's my first quote. All the attendees on there, everything starts with what? What is it when you're an investor, you're looking at investing something, what does everything start with? Go ahead, type into the question box what you think that is. And we'll see if we get the feedback. You know, I got to start having like a little contest. When the first person that gets it right, they're going to get something. So go ahead, type in. So Paul says an idea. Ed says return on investment. David says return on investment. Kurt says value. Close, Kurt. Close, Kurt. Johnny Knox says a business plan. Now, everything starts with valuation, which is what tonight's class is all about. It's all about valuation because a professional investor knows that it's about valuation. It's about what is your company worth. So let's talk about that for a sec. So what is valuation? And again, I got to preface this by saying this. So valuation, literally, I could go down 20 different roads, and real estate and buildings, intellectual property and patents, and there's a million different roads for valuation. We're going to take a really broad road. So if you're one of those real educated people out there and you're going, well, he didn't cover this, he didn't cover that, we're trying to make this understanding to the masses so you can understand the basic principles of valuation and what investors look for, check writers look for. So valuation is very easily, it's how the market, quote unquote, values a company. You know, what would your company sell for in the open market? So you're a brand new company, you're a startup company, maybe you got a napkin idea, maybe you got some sales, maybe you got some revenues, maybe you have a patent, maybe you have an invention. What would it sell for? And if you were to think about, well, if I was to sell my company for one check, I want $10 million for it. So then you're saying your company's worth $10 million. Now the idea is, how do you back that up? You know, how do you justify that? And then we have, in the investment world, we have a term called pre-money valuation. Pre-money valuation. And pre-money valuation is, what is your company worth, or what is the market value you're putting on your company before you start an offering, before you start to sell equity in your company. And then we have a term called post-money valuation, and that is, what is the value of your company, what is the worth of your company after your offering is complete. And again, these are terms that in our classes and courses and our coaching, where we talk about the language of capital, if an investor asks you what your pre-money valuation is, and you look at them with eyes glassed over and you don't know, you're dead, you're done. Your business plan, your offering document hits the trash can before you hit the door. So these are words, and this is language that you need to know. And everybody who's part of Angel Network in our educational membership, we have a whole definition of terms, like a 25-page document with all these terms, like a dictionary of the language of capital and these terms that everyone needs to know. So as I go through these, I want to point that out, how important it is for you to understand the language of capital. So now we're going to talk about, okay, so how do you calculate, in the basic terms, going back to what I said a minute ago, in the basic terms, how do you calculate valuation? So valuation is, and we're going to take an example of a company that's incorporated, because most companies that raise capital sell equity or some form of debt that converts into equity, and it's a corporation. And most of them are C Corps, and you know, there are instances where you do LLCs and possibly even sometimes S Corps, but the corporation of choice is a C corporation. And so you calculate your valuation by taking the number of fully diluted shares outstanding multiplied by your offering price, or if you were a publicly traded company and your stock was traded on exchange, you would multiply that market price per share times your fully diluted shares outstanding. So let me give you an example. Let's say in our company we have 8 million shares issued and outstanding. So those have been issued and outstanding, representing that. We want to sell 2 million shares of Series A preferred stock, or we have 2 million shares of preferred stock outstanding. So we have 8 million common.
Greg, excuse me.
Yeah.
People are stuck on the front page where it says Valuation Secrets with your picture. The PowerPoint is not changing.
Really?
Yep, your screen is. My screen is still on page 1. I was going to try to refresh mine, but some other people are typing this. There you go. Now it's working. There you go.
All right, guys. Next time, tell me a little bit earlier.
Well, I was checking in the background.
Okay, so there's that page.
You have that. Okay.
There's the page of the press release that I put out.
Run through those real fast. I was wondering if you had that. Run through those real fast. Okay.
Yeah. So when it comes to everything starts with valuation. What is valuation? It's how the market values a company. What would the company sell for in the open market? Your pre-money valuation. What is it worth before your offering has started? Your post-money valuation. What it's worth after. What a company is worth after offering is completed. How do you calculate valuation, which is right where we were. So here's the example. We have 8 million shares issued and outstanding, and these are common shares. And we have 2 million shares of a Series A preferred outstanding. We have 2 million shares in employee stock option plan. Now, those are shares that have been promised to be issued but aren't issued yet, but those would go into your fully diluted because they're going to be issued at some point in the future. And then we have 3 million warrants that we've issued through different transactions or different things. And again, a warrant's different than an option in that the definition from a tax standpoint, but in reality, it's still an option to buy stock at a set price for a set duration of time, and so it's a promise to issue stock. And then so now that says now we have 15 million fully diluted shares. So we have 8 million plus 2 plus 2 plus 3 is 15. And if we were doing an offering at $1 a share, then that would be, we would take $15 million, multiply it by $1, and we have a pre-money valuation of $15 million. So again, we're just taking the amount of shares outstanding, the options outstanding, that's our fully diluted, multiplying it by our offering price, and that's our pre-money valuation. Now I want to show you just an example that if we want to take a publicly traded company where you can go online and you know, look up a stock quote, just to give you an idea what this looks like. So Walmart has 3,466,666,666 shares outstanding. You multiply that by their price per share, $60, which is what their stock is trading at in the public market, we're saying the company is worth $208 billion. Now look at Google. Google, on the valuation side, is just a few billion dollars underneath Walmart. Isn't that staggering? Walmart's been around for 30 years, 40 years, the biggest retailer in the world probably, and now Google comes along and bam, they got a valuation almost as big as Walmart. It's amazing. But they only have 325 million shares outstanding, but their stock's trading at $633 a share. So you can see I'm multiplying the stock price by the number of shares outstanding, and I'm getting the valuation of the company. That's how you do it. That's how valuation is created when it comes from an investment standpoint. So if you tell me you have 10 million shares outstanding and you're selling stock at $5 a share, you're telling me your company's worth $50 million. I'm going, okay, you better justify that. So here, I'm going to give you a few more visuals and examples. Pre-money valuation, we have 15 million fully diluted shares times $1 per share. We have $15 million pre-money valuation. Now let's say we go out there and we sell 5 million shares at $1 a share. So we're saying, okay, my company's worth 15 million. We're going to sell 5 million shares at $1. Now, post-money, we now have 20 million shares outstanding because we had 15 and we sold 5. So now we have 20 million shares outstanding, and we sold it at $1 a share. So our post-money valuation is 20 million. So that's a really easy thing. It's just like you're adding the shares to your total outstanding, multiply it by your stock price to get your post-money. Now the only difference is we have more shares outstanding, but we got 5 million cash in the bank, right? So pre-money valuation, post-money valuation, your post-money valuation is going to increase by how much money you raised, but that cash is in the bank, and you have that many more shares outstanding. I hope that makes sense to everybody. So with that being said, that's kind of an issue. So now let's talk about what is our valuation considerations. What makes up our valuation? How do we justify this, and how do we really make this credible? So we have hard assets, you know, which would be book value, which could be patents, intellectual property, desks, chairs, automobiles, buildings, real estate holdings, you know, gold, silver, it could be anything that's a hard asset. Then you can valuation considerations take into consideration projected income and projected earnings. RPS is revenues per share. EPS is earnings per share. So anymore in the internet age, a lot of companies have traded and market valuations have been put together on revenues per share because they're not making any money, but they're generating massive amounts of revenue, which Groupon was a good example of that. But you can see how they got their valuation funded, and now the stock's off 40% now since they went public. That's another story. Projected growth rate is a big, big issue when it comes to valuation. If you're a company that's going to take 20 years to build significant revenues and significant earnings per share and revenues per share, as opposed to a company that's going to take 2 or 3 years like an internet play, that all comes into consideration on your valuation. Of course, market comparables, which is kind of like doing a real estate and doing real estate appraisals. Market comparables where you can point to one company or another. Then you maybe have like a weighted average where you're averaging other market comparables out there. And a lot of times, startups and early stage companies, we have to estimate, we have to guess, we have to make up, we have to use our best judgment. And at the end of the day, the bottom line is if we can convince an investor that we are worth $5 million or we are worth $2 million or we are worth $20 million, that's what really matters. You got to be able to justify it. I'm going to get into that here in just a second. And then, of course, valuation consideration is dilution, obviously, from future issuance of shares. So everyone's going to look at, and I'm going to get into this a little bit, the rounds of financings, because you got to look at financing in your company kind of like a baseball game. You never go out there and raise all the money you need in your first round. You always do round 1, round 2, round 3, round 4, and typically, not more than 3 or 4 rounds. But when you do that, you're issuing more shares, and this word dilution is a big issue because we're issuing more shares. And one of the things I like to harp on entrepreneurs is I've seen way too many entrepreneurs that throw around their stock like it's candy and it's not worth anything. And you got to be careful with that because your stock is worth something, and you should, as a board, you have a fiduciary responsibility to your shareholders to never issue stock unless you're increasing the value of the company. So that's a good whole other class. And then, of course, we have what we call risk reducers. When you have good management teams or you have patents issued as opposed to pending, when you have trademarks and copyrights and you have income, you have all these risk reducers. And the more risk reducers you can have, that also helps increase your valuation. So let's talk about factors that increase valuation, because this is what, at the end of today, we want you to increase your valuation. I want to give you some concrete things that you can do. I want you taking notes, and I want you to get off this phone call, and I want you to start putting things together immediately to increase your valuation. So what are those, and what do those look like? Experience of management. You really, really need to work on the experience of management. Make sure if you have holes in that area, you either need to articulate in your business plan or when you're talking to investors how you're going to fill those holes, or go fill some of those holes. And maybe you fill those holes that upon funding, this person's agreed to come on, or upon funding, this person's agreed to come on, or this person's lending me his name and he's going to advise me. And we're going to get into advisory board members in a minute. The size of opportunity. If you're in a market where the size of the opportunity is small, it doesn't increase valuation. So you want to articulate the size of your opportunity, but you also don't want to go crazy. There's a fine line of trying to sound like, well, what's your market? Well, everyone on planet Earth, because there's no one has a business where everyone on planet Earth is their market, except for maybe, well, not even a toothbrush company, right? It's like, it's just not there. That's a funny analogy, huh? But think about that. Your current revenues, the size of your offering, exclusivity in the space, which is a big one, intellectual property. All these things are things to increase your valuation, increase your valuation. Now, here's some ideas. Getting letters of intent. Can you get a letter of intent from somebody that says, yeah, I will buy from you, or yeah, I will do business with you? That's a great way to show credibility. It's a great way to show that you're out there doing it. It's a great way to increase your valuation. Board of advisors. Now, a board of advisors is a person that's not a board of directors. They don't have the liability issues of a board of director, and they're there to advise, but they're also willing to lend you their name and their expertise and their Rolodex to help you come along. And I'm going to show you some examples of that. Board members. If you have a weak board of directors, you need to have 1 or 2 people on your board. Investors love to see at least one outside board member on a board of directors. And we don't necessarily want 5-man and 7-man boards because we want people to be able to move and make decisions quickly. I personally like the 3-man boards, and then 5-man would be next. And I'd hate to go over 5. It is done. The bigger rounds you get, the more financing you get, and the bigger investor groups you get. But you want to get one outside board member on there because a professional investor likes that. Says, hey, look, they got an outside board member, and that's going to bring some objectivity to the board as opposed to the founders. Pre-sale contracts. There's all kinds of great stories of people actually pre-selling their product or service and getting those pre-booked revenues. So pre-sale contracts are great ways to increase your valuation and help you get what you need. Joint venture relationships. Another great way to fund is through strategic relationships and joint ventures where one person has one skill set or one asset they bring to the table, you have an asset and a skill set you bring to the table, and you agree to work together. And then that way you're not spending money and overhead and that kind of stuff. And joint ventures are great ways to do stuff. Testimonies, written testimonies. I'll show you some examples of that here in a minute. These are great ways to give credibility, increase your valuation, and show that you're for real. And again, some of these may seem insignificant in that a testimony is not going to increase your valuation by millions of dollars, but it can increase your valuation. And I'm going to show you an example in a minute. Celebrity endorsements. Depending on the celebrity, we happen to own a company and operate a company where we not only have an endorsement, but we have a partnership with a celebrity. And I just got news today that she has a show on Nickelodeon. She's only been on Nickelodeon since February, and I think it was yesterday, it was published that her show is the #1 rated cable show for kids. Not the #1 Nickelodeon show, which is the network she's on. She's the #1 kids show on the cable network of all the kids shows. And that's huge news for us, right? We haven't even talked about that, David Ned, so I don't know if you saw that, but that's huge. That's a huge. So that's different valuation increase than it is if I was to get, like yesterday, the mayor of Escondido was here, and he supports us, and he's given us endorsements, and he's given us testimonies, and so he's going to increase our valuation a little bit, but Symphonique is going to increase our valuation a lot. But they all help, right? They all help. Intellectual property, trademarks, and patents. And of course, whenever you do this stuff, it's not enough to just have the platitudes. It's like you have to actually show your evidence. And I love this line that when I teach marketing, I like to talk about factual evidence that when you're trying to present your case and you're trying to justify your valuation, you need to bring the factual evidence as if you're the attorney trying to get O.J. Simpson, and you're saying, the glove doesn't fit, you must have quit. You got to show the glove, right? It's not enough just to say the glove doesn't fit. You got to try to put the glove on his hand, and you got to show people your evidence. And so let me give you a couple of examples. One of them I want to show you is around the board of advisors. So again, a board of advisors is a less formal alternative to a board of directors and used by small companies. And advisory boards can be 3, 7 people, even more, and you meet periodically, but they don't have the legal responsibilities. And they are not a board of director. They're not a board member. They're just a board of advisor. And they're there to lend their name, their expertise, their relationships, because they really believe in what you're doing. So again, here's an example. One of the guys on our advisory board is Percy Miller, and he's a hip-hop entertainer. He's sold over 75 million albums. He's a former NBA player. He was listed in Forbes in 1998 as one of the top 10 income earners in 1998, and he's the founder of a television network called Better Black Television. And I could go on and on and on and on. He's actually listed as one of the top 100 most influential African Americans in the United States history. But okay, does that guy increase our credibility that we have something like that that's going to help us with things that we're doing? Sure it does. Absolutely it does. Here's another one. We were fortunate that we got introduced, I did, to Lee Steinberg. And Lee Steinberg is the guy, anyone see the movie, what's the name of the movie, guys?
Jerry Maguire.
Oh yeah, Jerry Maguire. Show me the money! Jerry Maguire. So that movie was made about Lee Steinberg. He was the world's most famous sports agent. He literally has secured billions of dollars for his clients. He was like the only guy that represented 8 NFL #1 draft picks and stuff like that. But more importantly, what he's done for charities is he has directed and helped raise more than $600 million to charities around the world. I mean, this guy is huge, and he's on our board of advisors. So that's an example of having him in our offering document, him in our business plan, and people knowing that we have him as a go-to guy to help us. He's bringing stuff to our table. Now, let me give you a couple examples. So you talked about testimony letters. We were fortunate that we did a partnership with DreamWorks. I know you probably can't read this through the internet, but it says DreamWorks letterhead. I have recently had the pleasure of doing business with Children's Educational Network, and they became a licensee, blah, 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 blah. And it says, I applaud their performance and welcome their involvement on future DreamWorks projects, right? So see, that's like a money magnet. That increases valuation because I have a multi-billion-dollar New York Stock Exchange traded company, DreamWorks, give me a letter saying, hey, we're happy with our deal with you, we like you guys, and we're happy to entertain involvement on future projects. That's strong. These are the kind of things that you got to get, and you can get them. If you ask for them, you can get them. Here's another one from the Miss America organization where we also partner with them, and this isn't the one that Donald Trump owns. This is the one that's been around for, I think, a century. In closing, we would like to thank you again for supporting Miss America's mission this year and the support of the Miss America organization, which help empower young women to have voices across. We are so proud that Lauren was able to work with you guys and speak to children across America and our stuff, and they continually call us and want to do business with us and work with us. So again, it's proof, it's evidence, it supports our case of our valuation, it supports our ability to get deals done with big companies. And again, we have more of these. I just want to show you a couple examples. So I hope you kind of get this, right, the importance of valuation and what this all means in the valuation. Now we're going to go really deep here for a minute, because it's going to take me, I think, about 10 minutes. We're going to start talking about why understanding this is so important. So hopefully you've grasped the concept of, okay, I know what valuation is, I know how to calculate it based on my offering and my stock price, and I get some ways to increase my valuation. But why is it so important? And Greg, put your money where your mouth is when you say this information is worth thousands of dollars to me, hundreds of thousands of dollars to me, millions of dollars to me. Okay, I want to point that out. This is so huge. If your valuation is too low, and you go to an investor and your valuation, let's say, is at $2 million, and you sell him a 30-year company for $500,000, or you raise $500,000, you just gave up 25% of your company for $500,000, which could cost you millions. So now let's say your company goes and it becomes worth $100 million. Well, you gave up 25% of your $100 million. 25% of your $100 million. Did you hear that? 25% of your $100 million for a measly $500,000, right? So what is that? What's 25% of $100 million? It's $25 million. So you gave up $25 million in exchange for $500,000. Well, you don't want to do that every day, right? and then that's what I mean by this is so important. It's so critical that you get this. But then on the flip side of that coin, we flip the coin up and we go from heads to tails. If your valuation is too high, you'll never get funded. You'll never get funded, which could cost you your future. If you never get funded, it costs you your future. Now that costs you millions of dollars, $5 million, $10 million, $100 million. What did that cost you because you didn't get funded? So it's just so important. And I'm assuming if you guys have watched the show Shark Tank, go ahead and type, yeah, I watched Shark Tank in the chat box, in the question box. Go, yeah, I watched it. I want to see how many people have actually watched Shark Tank. We have a bunch of people online, so I'm very impressed that everyone made it today, because last night we blew up with the internet down. But if you've seen Shark Tank, go ahead and let us know if you've seen Shark Tank. Because if you've seen Shark Tank, the #1 issue on every show, almost with every single entrepreneur, I'll bet if I went back and looked at them, it's probably 99 out of 100 entrepreneurs. Every single time, the issue they bring up is valuation. You want me to believe that you're worth that? You want me to believe you're worth that? Why would I do that? And then they hammer them on their valuation. And that's real life with professional investors. That's real life. That's how it works. And you say, okay, why is that? So now I want to give you that whole teach a man to fish thing. It's like if I get you to understand this concept I'm getting ready to explain to you right now, then you'll get it, right? So as a professional angel investor, as a professional investor who's investing in high-risk deals, these are, what we're talking about are high-risk deals, meaning that we have the potential to lose 100% of our money. So I'm going to write you a check for 50 grand, 100 grand, 500 grand. I have the opportunity to lose 100% of my money. And we know through statistics and through time that, and again, you can get this through the SBA and the Small Business Administration and stuff. How many, you've heard the stats, how many, what's the number you guys hear David and Ed about? How many companies fail within the first 3 years?
95 to 98%.
90%.
Yeah. So you think, so when as a professional investor, we're looking at that and we go, okay, if I invest in 10 deals, let's say 6 or 7 of them blow up, go out of business, 2 or 3 of them do okay, and one of them is my big home run. So professional investors, unlike unprofessional investors, which there's those too, and we're going to teach you how to get to those and where they all are. We're going to show you where everything is. We want you to understand everything. But professional investors, my theory is if you can make your investor presentation work for a professional investor, when you're working with a non-professional investor or somebody else, you're doing right by them. You're doing right by them. And it's going to be easy for you to raise your capital. So angel investors and professional investors, we want to earn 10 to 30 times our money. So if I give you $1 million, I want 30 million back, or I want 10 million back. And I want this, and that 10 to 30 is a big range, and that's tied to the time frame to exit. So if the exit's going to be in 2 to 3 years, I'm happy with 10 times. But if it's going to be 3 to 5 years, I want 30 times. Because again, when you divide 30 by 5 years, you have a 2.5 times or whatever that is per year, and you start to have an annualized return. And we want to make that much because we know a lot of companies are going to go out of business no matter how good they are and how there's just stuff happens. So if you can't speak to justify your valuation, you will be eaten alive by the sharks. And a lot of companies, now you might be listening and going, Greg, there's no way I could pay an investor 10 times. My business does not warrant paying that kind of return to an investment and leaving anything left over for me. Don't panic. That's okay. We can still help you get funded. We can still help you structure your deal. We can still help you point you in the right direction. But you're not going to get funded from professional angel investors. We're going to point you somewhere else because that's what angel investors look for. They want that 10 to 30 times. So
hey, Greg, and real quick on valuation, some people are asking what is the best valuation for a tech startup. The best valuation, it doesn't matter if it's high tech, if it's brick and mortar, if it's biomedical. It depends on your market size. You got to know what your market size is, how many people can your product reach to determine how big you're going to be is determine your valuation of your company. So it really doesn't matter what industry you're in when you're doing a valuation. It matters really about how much of the market size are you going to get according to your product or service.
Right. And there's no cookie cutter. There's no cookie cutter things, right? There's not a cookie cutter. So again, and I'm going to get into that right now. I'm going to try to give you guys a real world example and here's what I do. Is I'll take your financial statements, your 3-year, 5-year projections, and as long as you have reasonable projections, then we back into your valuation based on a return that we know our investors are going to want. So then you're talking to an investor about, as I hit my projections, you're going to make 10 times your money. As I hit my projections, you're going to make 30 times your money. Because that's what investors want. They want to know how much money they're going to make. They don't want to know how many widgets you're going to sell. They don't want to know how many stores you're going to be in. They don't want to know how many people you're going to change their lives. They want to know how much money am I going to get back, and when am I going to get it back. So let's go through a scenario here, an example. Company A has a pre-money valuation of $15 million and needs to justify a 10 times return. So that means $150 million valuation at exit, meaning that 3 years from now, when we sell the company, when we go public, when we're going to do whatever we're going to do to get our investors' money back, we have to have a $150 million valuation. Company B has a pre-money valuation of $5 million and needs to justify a 10 times return, which equals $50 million. So 3 years from now, I got to justify a $50 million company. And Company C has a pre-money valuation of $2 million and needs to justify a 10 times return, which equals $20 million. So here's my question I want everyone to answer in the question box. If you're an investor, and I'm asking you for money, and then we have 3 companies, one with a $15 million value pre-money valuation, one with a 5, one with a 2, and you want 10 times return on your money, which company are you more likely to invest in? Company A, Company B, or Company C? So type in A, B, or C. So we have a C. Keep telling. We have another C. We have a B. We have an A. We have a C. Okay, so the answer to that question is, what is an entrepreneur more likely to build? Is it going to be easier to build a $20 million company, a $50 million company, or a $150 million company? So see, to me, the obvious answer is that if you're comparing companies to companies to companies, it's going to be easier to build a $20 million company than it is a $150 million company. It takes a different skill set to build a $150 million company. It takes a different level of distribution, marketing, advertising, all that kind of stuff. Whereas there's $20 million companies, by the thousands, maybe even the millions, and then the higher the revenues go up, the smaller you find. So so I'm making the point that if you're going to go to professional angel investors, they typically want to see a pre-money valuation of $2 million and no more than $5 million. Because if I want to make 10 times my money or multiply that by 30 times my money, multiply all these numbers by 30, now they got to build a $60 million company, $150 million company, or a $450 million company. It's more likely that they're going to get those returns when investing at a lower valuation. And I hope you guys understand that. So the question is, okay, I get it. I understand valuation. I understand stuff. How do I combat this whole issue? What do we do about that? Okay, that's where it gets good. So now it's about deal structure. So if you can't justify the 10 times or the 30 times and you're worried about your valuation, you have to figure, okay, what's my deal structure? It could be debt, right? Maybe you're just getting the debt financing because that's the only way you can get your money. So then you get creative about debt and then maybe with an equity kicker. Or maybe you do convertible debt where, hey, I'm going to promise to pay you this money back, but upon this, this, and this happening, we're going to make it convert it into stock. And so convertible debt is typically almost always used in the first round of financing for companies because it's the most riskiest, and they'd rather have a promissory note to get the money back than having stock. And there's different tax reasons and different benefits to that from the investor standpoint. But these are the things that you got to know and you got to learn. And again, it would be, for me to lead you to believe that you can learn all of this stuff, expect you that, you know, in any reasonable amount of time, is ludicrous. You just can't do it. You know, guys like me have 20, 25, 30 years experience with it, and I still don't know it all. My favorite saying is, what I know fills books, but what I don't know fills libraries. But the idea is you want to at least know some of this stuff and have a basic understanding of it so you can get the expert advice. And when you get the expert advice, you at least know what's going on and have some idea of it. And then you have preferred shares. So with preferred shares, you can give preferential rights on liquidation to maybe you have intellectual property, maybe you have patents, maybe you can tie it to cash flow, you can tie it to revenues. There's all kinds of ways to structure deals and term sheets, and that's where you combat the valuation issue and this issue of, you know, how much money you need now. And that moves me into stage round financing, which I hit on a little while ago. It's important as an example that you maybe do your first round at 20 cents. And I'm going to only raise 300,000, and 300,000 is going to get me here, 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 and here. And with that 300,000, I can increase my valuation to this. I can get my revenues to there. I can get my patent filed. I can get my trademark filed. I can get this distribution contract. I can get that manufacturing contract. I can get this letter of intent. I can get this. You know, you can do that. And then you say, okay, 4 months later from now, 6 months later from now, a year later, it doesn't matter the time frame. Now I'm going to go do my next round. And now I'm going to sell stock at 50 cents a share because I've justified the increase in valuation based on milestones that I've hit. And then from there, we're going to go do a round at $1 a share, right? And so the first round might be at a valuation of $2 million. The second round is going to be at $4.5 million. The third round is going to be now at $8 million. So see, each time you're raising little chunks of, you're raising the money you need in a different round, but you're increasing your valuation, which gets you the money you need, but you're giving up less of your company. So it's the way to do it. And again, see, if you don't know this and you go out there and you raise money, and let's say you raise $1 million right off the bat, and you're able to raise money, you get the money, you're giving up too much of your company. Because I've seen it 100 times. I put $1 million in somebody's bank account, or investors do. What's most of that money do? It sits there. You know, you just don't go out and spend $1 million in 30 days, right? So, you know, you try to raise more than you need, because we always underestimate. You know, every entrepreneur I've ever met always underestimates what he needs. But if you think you need 200,000, maybe raise 400,000, and put some milestones in place and save your equity. But again, the bottom line is you must be able to justify your increase in valuation based on the accomplishments you made from the previous round and the money you raised in the previous round. So I hope this is all making sense to everybody. So with that being said, I'm gonna open it up for a couple question and answers. And what I want people to do is I want people to right now get a list out and go, okay, based on my company, based on where I'm at, based on what I'm doing, I want you to rack your brain and brainstorm again with everybody. What are 10 things you can do? 10 things you can do to increase your valuation. And as you come up with an idea, I want you to type them in the question box and see it. And then I'm going to tell it to everybody else so they can help get those ideas. And David, Ned, you feel free to jump in and give your comments. And we'll spend a few minutes on this, and then we'll move on to the rest of the presentation.
Greg, while everybody's doing that, would you say from an educational point of view, and I talked about this in the very beginning, that even though this material for a lot of people seems in depth, there's so much more to understanding the language of capital and the process. I mean, this is really more of an elementary position of understanding on valuation. Would you say that's correct?
Yeah, no, that's what I kind of wanted to say at the beginning. Is this is just the basic, you know, the layman's term of valuation, but it is the foundation for your structure, for your offering, for your price per share. And again, if I said to you, well, do you want to do your stock? Do you want to sell stock at $2 a share or 20 cents a share? You might say, well, what do you mean? And, well, I want to do a $2 a share. Well, why? And there's reasons why you do it 20 cents as opposed to 2, or 2 as opposed to 20. And and there's all these issues. It's just all a process. It's all a big learning process. So we're getting things like sales, copyrights, international copyrights or trademarks or patents could be good. Or, it says, what I have is international patents, not just in the USA. See, that's good. That's really big. So now, because the world's a much bigger place than the USA. Celebrity backers, celebrity endorsements, Paul said, experienced board members, even just completing a patent application. Filing, which really cheap, it's only like $100 to do a provisional patent. If you have an idea and you haven't filed at least a provisional patent, go you got to get a lawyer, and of course we have lawyers we work with, we can recommend. You got to get that done, right? You got to get a provisional patent filed. Endorsements from powerful people, I like that. Celebritizing your brand. Okay, so here's a good question that Nathan asked. He says, under the Jobs Act, raising up to $1 million require external audit. You have to get audited financials under the new jobs plan to raise $1 million. How will that affect valuation? It doesn't. It doesn't, because valuation, see, your audit would show your book value, it would show your revenues, and really all it does is it guarantees some level of transparency on your financial reporting, because so many people have put out bogus financial statements. But as far as your valuation for investors, if you had a lot of revenues and you had a lot of profit margins, if you had something you had revenues and you showed 40% profit margins as opposed to a company that showed 8% profit margins, it would really help in your valuation. But for the most part, it's all going to be based on your upside potential, your intellectual property, how big a market, your market size, all that kind of stuff.
And you know what, Greg, one thing is we could show a lot of people how to do that, but there are companies out there called CVAs, Certified Valuation and Analysts, and they, for a fee, will give you a valuation of your company. Same thing with CPAs who have accreditation in business valuations, called an ABV. So there are organizations out there that you pay a fee for that are licensed to give you basically an external audit of, quote, how much your company is worth. So there are organizations out there that do that.
Yeah, and then business brokers do stuff like that as well, and they have people that do that as well. And again, those type of valuations are always going to be a lot lower than us entrepreneurs want. And the biggest sin that every entrepreneur wants is they think their company's worth 10 times more than it really is, because they don't want to give up their baby, or they and again, you got to always keep in mind, it's better to have, you go back to that Microsoft valuation, you don't need to have a big percentage to be worth billions of dollars if you have that right kind of company. Okay, so we're getting some good stuff and some good stuff. So you're listing your 10 things. This is going to be part of what we call your money magnet portfolio, right? When you get ready, or you're in the middle of raising money, or you're getting ready to raise money, you're going to be putting together your investor package, and your investor package is going to include these letters of testimonies, these letters of intent. Your offering document is going to include your trademarks, your patents, all this stuff. You're going to put together that package that becomes a money magnet as opposed to a money repellent. So as we kind of go wrapping up today's thing, let's talk about what's coming up next. So the Angel Money and Crowdfunding Bootcamp webinar series is happening every Thursday at 6 o'clock. We did today's because of last night's internet problem. Next week, we're going to do Crowdfunding Secrets Revealed. We're going to go over the new crowdfunding bill in detail. We're going to talk about how you can use crowdfunding currently and what the secrets, some of the secrets to that. And then from there, then the following week, we're talking about Capital Team, how to leverage other people, relationships, legally, to help you find investors and raise capital. We're going to really talk about money magnets that get you funded, and the real significant ones, and how you put those together. And we're going to talk about those mistakes. We're going to keep hammering. The mistakes come up in every webinar, but we want to kind of put those in and really talk about those, because I just hate to see these entrepreneurs on Shark Tank get embarrassed on national television. And like I said before, Ed and I have been at different angel investor presentations. We see these entrepreneurs get up there, and they mean well, and they're good people, and they just, excuse the expression, barf on themselves in front of a bunch of check writers. And we want to help people prevent themselves from doing that. And then we want to talk about the 3 lessons we learned from Shark Tank. So one of the reasons we're doing these webinars is we really want to accelerate your ability to get funded. And we have been asked over and over and over to do an event. So we have finally scheduled the first ever angel money and crowdfunding boot camp. And like we're doing today, we're going to do 3 full days in San Diego, basically 12, 14-hour days where we're walking you through, holding your hand, explaining every facet of this entire fundraising process. It's going to happen May 31st, June 1st, and June 2nd in beautiful San Diego. Beautiful time to come out here. We're going to have multiple experts involved with us. David Stanley, who this guy's a celebrity in his own right. He's Elvis Presley's stepbrother. Actually grew up in Graceland Mansion, went to over 2,000 concerts with Elvis Presley as his bodyguard, and actually was there and found Elvis, as he graduated to heaven in the bathroom. Barry Spilchuk, he was the author of A Cup of Chicken Soup for the Soul. He's raised money for his companies, and he's also coached over 10,000 entrepreneurs. So we're bringing you some people that are real-world people that have really raised money. They've taken our advice. They've worked with me. I know them personally, personal friends of mine, and they're going to help us. Larry Benet is called the Connector. This guy is so well connected. It's just unbelievable. And he's going to show you how to use relationship-building strategies to get into doors, to build relationships, to get funded to anywhere and anybody you want to. He's incredible, an individual. Jim Burke is our personal SEC attorney, securities attorney from Washington, D.C. He's going to come. We're going to talk about legal compliance. We're going to talk about how to do it right, how to make sure you don't make the mistakes. And believe me, I've made them. So we know we want to make sure we steer everybody with we want you to over-comply. We want you to have more compliance than you need. We want you to break any rules, any securities laws. And in this regard, do not listen to these webinar series and run off and start raising money. You must have an attorney because there's federal laws you have to comply with, and there's state laws you have to comply with, and they don't necessarily match. Because that's how great our government system is. They create different laws, different rules. So it's really, really important that you do that. And then we have a couple mystery guests that basically we haven't announced yet, so we're going to use those. And we're also going to make some phone calls to other angel investors that are friends of ours that are here in San Diego, and we are going to do on day 3 a pitch tank. So other than Shark Tank, where the sharks eat you for life, we're going to do a pitch tank, and we're going to allow a few lucky entrepreneurs that are ready and they're prepared. We're going to allow them to get up in front of me, David, Ed, and some other angel investors and give a presentation, and we're going to critique your presentation, and we're going to show you what's wrong, and we're going to do it as a crowd experience and let people know what a good presentation looks like and what one doesn't look like, and I might even do one. And there's a possibility, no guarantees, obviously, ever, but somebody might get funded and might raise some money at this event. That's our hope.
Hey, Greg, when you're talking about that pitch tank, I mean, there's going to be some people that learn that material in those 3 days, but they might not be 100% comfortable doing a pitch completely by themselves. Is there a way that we can give them some assistance in that process when they do the pitch, or maybe they do some one-on-one counseling for a few minutes so that they know how to do it, or somebody just kind of by their side so that they don't feel like, somebody who's afraid to kind of give a pitch or speak up in front of a public audience, we give them some help?
Well, you mean at that event?
Yes, correct.
Well, Barry's going to do a class on presentation skills and what should be in a good presentation when raising money.
Perfect.
So we're going to have a whole class and a whole course on that. And then, of course, we're going to all be there. You, me, David, and all of us are going to be there all 3 days, and we're going to hold your hand, and we're going to put some stuff together. And I'll tell you something else we're going to do. We're going to organize, and we're going to put you together with the most. I'm going to say this, and this is a bold statement. This is going to be one of the best networking events you've ever been to, because we are great at organizing, networking, and masterminding. And when I have a group of our goal is to have 100 people in this room, right? And as 100 people, we could all find, hey, that guy might give me a letter of intent, or he might be a person that manufactures for me, or that guy might buy from me, or that guy could be on my board, or that guy could be on my board of advisors. So we think that when not only we're all like-minded people, we're all entrepreneurs, we're all chasing our dream, we all want to make it happen, but we're gonna create I'm at a loss for words. We're gonna create the mechanisms in place so you get some money magnets at this event. Because believe me, my Rolodex is deep. I know a lot of people. We're going to have lawyers there. We're going to have intellectual property, trademark, patent, trademark attorneys there. We're going to have SEC attorneys there. We're going to have business plan writers there. We're going to have people that really, really can help coach you and mentor you other than us. So I'm very excited about that.
Hey, Greg, I just want to point out that in the chat section, there's a link that people can utilize if they want to click on that link. So do you want to tell them about that?
That's coming up. And I think you have to put it, you have to click on it, answering the question, and post it in there too.
Okay.
Okay, so here's what we're going to cover at the Angel Money and Crowdfunding Bootcamp. Legal compliance, corporate finance, language of capital, deal structure, intellectual property, do's and don'ts, various forms of financing, everything from debt to credit card to equity, the convertible, to internet, to financing, to joint venture, to strategic. We're going to cover all of that stuff. We're going to talk about crowdfunding in detail. We're going to talk about exit strategy. If you don't know an exit strategy, have an exit strategy for your investor, you're missing the boat. You have to have an exit strategy. We're going to really help you with the money mags and talk about the money mags. We're going to help you and give you handouts and things where you really get what has to happen with your money mags. David and Ed, we're going to talk about the check extraction process, and that's probably not a real, that's probably not the nicest way to say that, but that's the term we use, right? Because the bottom line is when somebody says, yeah, I want to invest, you got to get the check, and the check's got to clear the bank. And then what do you do after that, right? Now you got to give them a stock certificate. Well, how do I do that? Then you got to have your subscription documents. What do I do with those? And then I got to file a form with the state. I got to do, then I got to file forms with the feds. We're going to teach you all the stuff about how to get the check, what to say to get the check, the words, the language, the sales process, everything. And then where do I get the investors? And we're not going to, you will go home with a list, a database. And I don't know if we'll give it to you in an electronic format, but it'll be in a printed format for sure, of different angel groups and different places of where you go. We will clearly show you a dozen, as a matter of fact, we need to sit down and write down, is it 101 different places to find investors or 12 places to find investors? But we're going to come up and show you exactly where you find investors, exactly where you get them, how you find them, how you start your conversations with them. And again, I'll make a comment of one of the guys, Mike, that we were talking to. He's got this cool business where he trains dogs to be protection dogs. And he's like, every time I open my mouth and start talking about dogs, the investors turn off. And again, it's the sequence of his presentation that was wrong. It's his languaging skills that were wrong. Because he's got a good little business, but he doesn't know how to structure it. So we're going to help you. That's all the stuff we're going to cover, and then some, at the 3-day boot camp. So if this is something that you think, I'm in, I'm ready to go, then you're going to go to angelmoneybootcamp.com/yes. Now, we set this up as the tickets were $1,997 for the first person. And then we set it up so the first 20 people get an early bird special, which is $500 off. So that's $1,497. And then the second person, so everyone wants to come with a partner, the second person only has to come for $997. So that's how we set it up. Well, after last week's webinar and after talking about it, and we've literally talked to 50, 60, 70 people, we've decided to do something crazy. We're cutting it in half, 50% discount. So everybody who wants to sign up at a 50% discount, we're going to give you guys a 50% discount over and above the early bird special. So if you sign up for the boot camp right now, your investment to go is $748.50, and the second person is only $498. And we know this is going to make it more affordable so you can get your airfare. I mean, we basically just paid for your airfare and your hotel room. So now you're getting in, but you got to go sign up now. You got to go to angelmoneybootcamp.com/yes and sign up. We've got to get these tickets sold, and we're starting to get momentum, and we're starting to get more people registered for the webinar. We just released the 7 Secrets to Raising Capital webinar. That's out there. That's growing momentum. I have about 20 friends of mine that have all agreed to email their database, anywhere from 20,000 people to 150,000 people. And I'm going to say, I think realistically we were going to have as many as 200,000, maybe as many as 1 million emails go out about this Angel Money Bootcamp in the next 4 weeks. So I can promise you these early bird special tickets are going to sell out. We're going to do our best to fill this place up. We're going to put on the best event. And here's the bottom line. You order now, you're going to save over $1,700 for 2 tickets. Again, that's your airfare, your hotel, your food, and that's everything else. And the bottom line is there's no risk. If you were not satisfied after day 3, at the end of day 3, if you come up to us, me, David, or Ed, any one of us, and you say to us, I don't think you guys provide the value, I don't think it was worth it, we will give you your money back. We will give you your money back. No questions asked, no weasel out clauses, no, qualifications, just a good old, man to man, woman to woman. Hey, I sat through it, and I just don't think this was worth the money. If you don't think it was worth the money, we're going to give your money back. We know, beyond any reason about, there is no one teaching this stuff. There's no one teaching what we do. And there's no one that has the experience that we have that I know. And I've seen a few people try to teach this, but I've never seen anything like this before. And if you're serious about raising capital and you really want to make this happen, you need to figure out a way to get to this boot camp, because it's going to be like, you're going to be like taking what take you 3, 4, 5 months to do, and you're going to be able to get it done, and you're going to get it done 3 days. And again, there are those people that say, Greg, I don't even want to wait to the boot camp. I don't even want to wait to the boot camp. How do I get started now? We have a coaching program, and you can call our office at 760-233-2863, and you can talk to us about our coaching program. There's people that don't even want to wait, to the boot camp to get going. If that's you, call our office. We'd love to talk to you about it. So here's how you do it. When you get to that page, angelmoneybootcamp.com, when you get to the checkout page, there's a coupon code form on the page where you put in your credit card. It says, what's your discount coupon code? You enter the number 50 and the word off, O-F-F, all together, 50 off, and you get 50% at checkout. And you hit apply, it automatically calculates and gives you 50% off, and you'll get your 50% off at checkout. So we hope that you're ready to sign up with us. Let's go ahead and ask, if you guys got any questions, go ahead and type your questions in the chat box, in the question box, and we'll answer that stuff for you. Any questions?
Greg, I'd like to just point out that the information that people are getting now, I was talking to somebody the other day, and the information that people are getting free in these webinars is literally like your elementary education. But when you go to this boot camp, day 1 is like getting your high school diploma, day 2 is like getting your BA, and day 3 is like getting your master's. So that's what people need to look forward to.
Right. No, it's accelerating the process. Accelerating the process. And they ask me what the dates again are. The dates are May 31st, June 1st, and 2nd. So that's the dates again. And again, we want to do everything we can to help you out. It's going to be a fantastic event. And all you got to do is go to angelmoneybootcamp.com/yes. And everyone understands we're going to continue to give this free coaching away. And obviously, people are telling us how they're saying this was great, fantastic presentation, fantastic content. We love it. We know this is good stuff, and we're not trying to be I'm not trying to be boastful. I'm just saying, see, I have this specialized skill set, and Dave has this specialized skill set. Dad, we have this specialized skill set. We've been doing this for 20, 30 years. And to us, free enterprise, capitalism, the American dream, it's all about entrepreneurs. We love it. And again, but we're like everybody else. This is a business for us. We want to get paid for our knowledge, and our knowledge is very valuable, and we know that we can accelerate your path to capital. We know we can accelerate you getting your funding faster. What's that worth to you? What's that time worth to you? Conti's asking a question. It's a good question. What do you think about cleaning up the cap table, as we've brought in many investors who have traded stock for our services and labor? I think that's fantastic that you've bartered for services and stock and things of that nature, and you have 2 rounds under your belt, and now you're going to a 3rd round. I don't know why. I can't tell you on this call. I'd have to talk to you, Conti, about exactly what that looks like. But you might have to do some cleanup. You might have to do some restructuring, because the market's changed, and it is what it is, and it's all about getting the funding to get to the end of the road. But maybe not. And then Mr. Betterton, hey, Mr. Betterton, hey, thanks for hanging in there. A friend of mine, Charles, is on here. He says, thanks for adjusting the tuition. He realized it's worth far more. No, I appreciate that, Charles.
Yeah.
And Hart says, Hart has joined later. Is this people contemplating a startup? Yep. If you're contemplating a startup, this is exactly what you need. We primarily deal with startups in early stage. We typically don't work with companies that are doing $3, $4, or $5 million in revenues. They're typically under $1 million in revenues or no revenues at all. And you're looking for that seed capital round and that early stage round to get your company funded and get things going. Hey, that was good. We did this in an hour. I was thinking it was going to go long. And the valuation's it's a tough one.
Awesome. Excellent job.
So Donald's asking, if I have $40,000, what's the best way to raise more capital? You want to take a run at that, David Ragg?
I'm sorry, say that again?
Are you seeing the questions?
No, I didn't see that question.
Asked, but I do real quick. I'll go back. Someone did ask about the price again, Greg, because they thought it was $3,000. The special promotion right now is we're doing the $748 if you enter 50 off at the checkout. So that is the current price for the 3-day event in San Diego, $748. And most people who, when you're paying your attorney, they charge between $300 or $400 an hour. That's 2 hours of an attorney. We're going to have attorneys there you can talk to right there on the spot. So it's really a good deal.
But let me answer Donald's question. He's asking, he says, $40,000, what's the best way to raise more capital? Be there May 31st, June 1st, and June 2nd for that $748, and you will find out for that $748 what's the best way to raise capital, what's the best approach you can take to raise money, who you need to go after, and what your exit strategy should be, how you can do the valuation for your company, all the way across the board. You really want to know how the best way to use that $40,000? Invest in what you're doing and what you believe in, and you will be able to reproduce more.
Right. Well, that, and if you're ready, and if you don't want to wait till May 31st to get going, call our offices at 760-233-2863. I'm going to send that number, 760-233-2863. It's on the screen, and we'll talk to you about how we can help you get going right away. Because, again, that's such a generic question, Donald, about, if I got 40, how do I raise more money? What's the best way? Well, see, without us knowing what your company is, your cap table, your financial structure, your exit strategies, your upside potential, we can't just give you an answer. It's like there's just too much information that needs to be known there. Oh yeah, there's all kinds of creative financing options. And then Conti says they've raised a $100,000 founder round. They raised the $250,000 plus round A, and now they're moving into round B for $500,000 to $750,000. So congratulations, Conti.
Yeah, that's awesome.
And you should, if you would like to call and talk to us about, because see, that's the kind of person that she's already raising money. They might need to clean up their cap table for this next round. It's a little bit bigger round, deal with a little bit different investors. How are they going to do it? If you feel you need to, you want to call, give us a call, and we'll talk to you about that. And that name sounds familiar to me. I probably know her. I think that's a her. Conti, are you a her?
Jerry.
Oh, Jessica and Jerry. Gotcha. Okay.
All right, guys, we should wrap it up.
Okay, everybody. Well, this has been Greg Ryder, Ed Bracken, and David Spoon. We appreciate you guys listening and tuning in to our webinar. Get to angelmoneybootcamp.com/yes. Enter your 50 off, and that's not going to take advantage of what you can. We appreciate your time. We're going to end the recording and do what we do. Wake up every day with an attitude of gratitude and tell somebody you love them. Thanks, everybody.